Okay, well, here we are. We are finally wrapping up the last section of the entire class. So, everything that we've learned up so far is that we were primarily gearing towards completing the accounting cycle. So, here we finally reach the end where we're going to complete the closing process. Now, what is the closing process? It is pretty much steps 5 through 10. So, again, when we were dealing with the coffee cafe, right? This is the only example you'll have for chapter 13 is that we're going to use everything that we've done for coffee cafe and we're going to properly complete the accounting cycle. So once again, the accounting cycle are these 10 steps. We've been practicing looking at a scenario, right? We determined whether the information is enough to record, or in this case, we've collected those source documents. Then we collected all those bills, all those invoices, all those receipts. And then now we've also analyzed the data and we sorted them and we've journalized them. Okay? And lastly, we've also practiced placing them into the ledger. Okay? So once again, we're going to be preparing the unadjusted trial balance, which is step number 5, all right, which is going to be things that you happen at the very end of the given period. So it's not the one that we've been doing every week. That's just a regular trial balance. That's just to keep us in check and keep us in balance to ensure that when we are doing our accounting, that we haven't made any mistakes yet so far. So far, every trial balance that we've completed, we've always balanced our debits and our credits. So that means we've been doing really good so far. So then, right when we reach the end of the given period, which in our case is the end of June, that's where we're going to complete an unadjusted trial balance, okay? And then step number 7 is to complete Step number 6 is where we're going to actually complete the adjustments. So if you guys remember, adjustments are anything that you have to wrap up your entire books for, right? We'll go through the last 10 steps once more again together. And then we're going to complete the financial statements, close out our books, and then do a post-closing trial balance. So once again, starting from step 5, what we're going to do is when we reach the end of the given period, we're going to do another trial balance, but this time it's wrapping up our books. So this is the very last thing that we have to do in regards to the very last day. Okay, once we get that our numbers match, so my debits match my credits, that's where I can proceed to my adjustments. So once again, what are adjustments? Adjustments are anything that you need to complete at the end of the period. So for example, periodic inventory. We have periodic inventory in Coffee Cafe, right? We have our coffee mugs. So we need to do an adjustment entry there. Okay? We need to adjust for depreciation, bank reconciliation. You know, if we need to do a petty cash refund or replenish the petty cash, we need to do that. That's going to be considered an adjustment entry, all right? We need to adjust the office supplies that we used, cost of materials that we used, anything that we could see that we either, so in context, when we make adjustments, it's usually things that we used, okay? So for example, periodic inventory. We didn't technically use stuff, we sold stuff, okay? Depreciation, we used the machines. Office supplies, we used the office supplies, okay? Cost of material, we used the material. So anyways, so that's what we got to do. And there's a few things. So if you've been looking at the chapter the week 5 and adjustments worksheet, there's a lot of adjustments that we have to go through. All right. So once we do that, right, we're going to plug our journals in, right, because we have to complete a transaction to reflect our adjustments. So once again, we got to complete our periodic inventory adjustment. We got to complete our depreciation. And once we do that, then we must complete the adjusted trial balance. So if you notice this, every time we place something into the journal, the thing that happens after that is going to be your ledger, and then after that's going to be your trial balance. So same thing here. We're utilizing the journal because we're making our adjustments. We're going to plug that into our ledger, and then we're going to plug in our numbers to complete our trial balance. So in this scenario, anything that affects the journal is you're going to have to complete a trial balance after it. Okay? So here, I did my adjustments, and now I placed them into my journal. And then I placed it into my ledger, which then I'm able to compute my trial balance. So at the end of my adjustments, I must complete an adjusted trial balance. Okay? Like A adjusted trial balance, not UN. Okay? Now then, once we get there, our next step is to create our financial statements. Once again, each financial statement must be in order. Okay? So the very first one we're going to complete is going to be my income statement. So notice this, all of my accounts, they're all main accounts. So that's exactly why for the unadjusted and the adjusted trial balance, we're going to be practicing plugging everything in using the main accounts. All right? So, because if we use main accounts, it makes it that much easier and simplified to create our financial statements. You definitely don't want to see too many accounts because if you remember our last trial balance, how many accounts did we have? We probably had over 100. So this is going to be shrinked up to only maybe 20 or 30 accounts. So that's why I want you guys to practice that as well. But let's take a look here. First we're going to do is we're going to complete our income statement. How do we complete our income statement? First things first. We're going to tally up all of our revenues. So anything that dealt with sales. So anything that affected sales. So sales returns, allowances, sales discounts. All of that's going to be placed at the very, very top because that's the amount of profit that I've earned. All right? Once you get all of your sales or all of your revenues, then you're going to go ahead and go against it with every expense that you have, starting with your cost of goods sold first, because your cost of goods sold is directly correlated with the inventory and the product that you sold. Okay? So in our case, we have cost of goods sold and we also have cost of material. Okay? Which we'll get into later on. So here I got my sales. I'm going to counter against my my cost of goods sold to get me a gross profit. Once I get a gross profit, right, that's just purely based off of sales and purely based off of the direct correlation of inventory, right? Then we're going to counter it against every single expense it took to operate my business. So therefore, advertising expense, rent expense, purchase expense, all of that, all right, including depreciation and non-cash transactions. So amortization, bad debt, it's all going to go against it. Okay? Once we figure out our total grand operating expenses, right, we're going to subtract that right out of my gross profit to get our net operating, net operating. Okay. Anything else that affects the income statement will be any other income or any non-operating expenses. Okay. So remember, those are going to be placed at the very, 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 very bottom. Okay. That will either increase your account or decrease your account, right? Other income will increase, non-operating expenses will decrease. Once we've plugged in all of those extra numbers in there, that's where we're going to get a final number, which is going to determine whether you have a net profit or a net loss. Okay. If you have a positive number, you have a net profit. If you have a negative number, you have a loss. Okay. Now, once we get this net income or net loss, now we must plug it in to our statement of equity. Okay, in this case, we have owner's equity, and we have two choices. Okay, especially when we actually gain a profit or income, right? If our net income is positive, that means we have two choices. We can either pocket the profit or we can reinvest it into our company. Now, if you're a small business, the best recommendation is you're better off to reinvest into your company versus take that money and pocket it for your own personal reasons. Okay, because not only did it cost you so much to even build your company, you owe a lot of money. So it's very, 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 very good that if you take that money and just reinvest into your company. Okay. Now, if you have a net loss, unfortunately, you don't have options there. You are obligated to take it right out of your equity because you have a loss. Therefore, your company must cover that loss. So that means they must take the money that you're originally invested in and cover that loss. So that means you should have when you have a negative number, it's going to decrease your total equity. Okay, so that's that right there. Okay, now again, other factors that contribute to your owner's equity is going to be your capital contributions. Once again, capital contributions are basically any money that you invested that's not from your business, money that you personally invested into your company. So if you remember from Coffee Cafe, right? We got a total of $30,000 investment. That's going to be anything that is not from the company. It's your own personal money that you place into the company. That's going to be a capital contribution. Okay? So again, capital meaning money, contribution meaning you place it in there. So pretty straightforward, right? And anything that affects your owner's equity is also if you withdraw money from your company, which, yes, we've seen it before. We do have owner's withdrawal. So once again, we're going to start with our beginning balance in our equity, right? Whatever we started out with. Then we're going to add if we have a net income. We're going to subtract if we have a net loss, okay? We're going to add our capital contributions, and we're going to subtract our owner's owner's withdrawal to get us a net ending balance, or in this case, a net owner's equity account, right? It's always going to be a credit, and in this case, it's determining the value of your company. So again, if you have a net income, you've increased your company. Capital contribution, you increase the value of your company. Owner's withdrawal, you decrease your owner's equity. So once again, once we've completed that, then the next step is going to be, so once we get this new ending balance in your owner's equity account, this number is going to be important because it's going to apply to the very next one, which is your balance sheet. So once again, the balance sheet, serves one thing, and that's to answer the accounting equation. So here we're going to take a sum of all of our assets. So we're going to list every single asset that we own. All right. And we're going to list out all of our liabilities. And equity we're given because we solved that from the previous worksheet. So here we're only doing two things. We're only tallying up our assets and we're only tallying up our liabilities because equity is already given. Okay? And the one thing that must hold true must be that your assets must equal your liabilities plus your equity. Okay? And if for some reason you do not balance, there is a discrepancy somewhere in your trial balance. But if you completed the trial balance and everything came out fine, your debits and your credits match, then your trial balance should have no issue. You should be able to get your total assets to equal your liabilities plus your equity. That should be equal. Okay? So once we've computed this, then we're going to compute our statement of cash flows. So once again, we're going to take everything that we took from our we're going to take everything that we took a look at in our balance sheet, and we're going to bring it into our statement of cash flows. So how we understand this is it's broken into three categories, right? You have your operating activities, you have your financing activities, and you have your investing activities, okay? Operating activities will consist any of your current assets, your current liabilities, as well as your other assets, okay? It will also include non-cash transactions, such as anything that we've done for the adjustment. So if you did your depreciation, you're going to have to add that back in because we're looking at the statement of cash flows. We really didn't spend money to depreciate anything. We just transferred money. We call that a non-cash transaction. All right. So when we build our statement of cash flows, we're going to start off with our net income. Okay. And then we start putting in our operating activities. Then next is financing activities. Investing activities. Let's do that one first and then financing after. Investing activities are going to be anything that is a fixed asset. Okay? And then your financing activities are going to be your long-term liabilities. Okay? And then at the very end of it, you should have a net amount for each one. So you calculate your net income first. You're going to either add or subtract your net operating. Then you're going to either add or subtract your net investing. And then you're going to either add or subtract your net financing. Then you're going to get what's called a net balance. Then you're going to take that against your original investment or your what you started the company with in your cash. So, which is your original investment, okay? So in this case, I'm going to start off with my bank account or my checking account as of June 1st, okay, in our scenario. Then we're going to compare when we take our original amount that we started out with and take it against our net financing, we should get at the very end to match our ending balance in the checking account as of the end of the given period. So in this case, you're gonna take two numbers. One is going to be your beginning checking balance as of June 1st, and then the last number should equal out your ending balance in your checking account as of June 30th. Okay. Now this one poses a lot of issues, especially if you are in an accrual type basis type of a company. However, once again, if you are working on your own personal company and you do your own books, this should be fairly a lot more easier, especially because you should be able to, you know, recognize what are your, current assets and stuff. But in this case, usually this one is a tricky one. If you do not balance, that is okay. It is not the end of the world. This statement is just only showing you how much cash is actually flowing into your company and how much cash is actually flowing out from your company. So again, this statement is not as important as your income statement, your statement of equity, and your balance sheet. Okay, this one's just showing, it's just basically taking an accrual type basis of a company and converting it into a cash basis type of company to show the external and internal users how much money is actually coming into the company. Because especially when you're dealing with sales, right? If you let everybody have sales on an account, how much money are you actually getting from your customers? How much money are you actually profiting? And that's what this statement proves. It's not one that you can make any projections for. It's not one to make any other useful information except to understand how much cash is really coming into your company and how much cash is actually leaving your company. Okay? So once we completed all 4 financial statements, then we move on to step number 8, which is to properly close out your books. So as we've mentioned this before, how do we close out our books? We have to close out our temporary accounts. Therefore, because our temporary accounts is going to be our revenues and our expenses, it's a perfect measurement of how we can determine profitability when it's on a month-to-month basis or whatever your accounting period is. So once again, because we have to understand this, your revenues, every month or every time you do your revenues, you're never going to reflect the same exact revenue every single day, or in this case, every single month. Maybe this month you profited a lot, next month you made a loss, the following month you made a profit, right? This is exactly why we have to close out our temporary accounts, because it's a perfect form of measurement, right? Because if something is a variable, right? So something such as like revenues, right? You're never going to get the same exact numbers. Then that's a perfect way to measure it. And what we want to do is we always want to start measuring from 0 until the very end of whatever your accounting period is. So for example, right? If I close out my revenues every single month, if I start at 0 every single month, every month I keep track of my revenues, I get some kind of number at the end of the month. All right? So that's what I mean by it's a perfect measurement. So once you've realized that, then we also have to know our expenses also come into play as well. You're never going to have the same exact amount of expenses every month. Yes, you have some fixed assets, fixed expenses such as rent, right? Or depreciation, right? Those are fixed. However, maybe this month you incurred advertising expense. Next month you didn't incur advertising expense. Maybe this month you decided to have a purchase expense that went way over. And then the next month you don't have any purchase expenses. Okay? So every month that you conduct your expenses, it's not going to be the same. So that's exactly why these two account types have a perfect quality in them. It's a perfect way to measure profitability because it's taking all of the money that you earned and it's going to be going against all the money that you spent to conduct your business. Okay. So what that means is we're gonna be taking our revenues and we're gonna take all of our expenses, and what we're gonna do, excuse me, and what we're gonna do is we're gonna close them out to our income summary. So once again, income summary is going to be an equity account. And basically what an income summary does is it's just another placeholder for equity, okay? In corporate terms, income summary is the same thing as retained earnings. And then you can choose what you want to do when you have a retained earnings. You can either take those retained earnings and reinvest it back into your company, or you can hold on to that retained earnings until you figure out what you want to do with it. But in most cases, usually the retained earnings is normally reinvested back into your company, okay? Unless otherwise you are profiting or you're taking that money for yourself. So again, income summary, retained earnings are the same exact account, except one is for private companies or smaller companies and one is used for corporations. Okay? So once again, we're going to zero out all of our sales into our income summary. So again, if we understand this, what normally increases our sales? On which side increases a sale? It's going to be the credits. So if we understand that if in order to increase our sales, we would credit it. In this case, we're going to be working backwards. We're going to take every single sales account, revenue account, and we're going to zero them out by either debiting them into our income summary. So in this case, I'm going to debit all my sales because I'm zeroing them out. I'm going to look at my ledger. I'm going to see how much sales I have, and I'm just going to counter them with a debit and place it into income summary. Okay? Same thing's going to go for all of your expenses. So that includes your cost of goods sold as well. Anything that's an expense, this is what we're going to do. We're going to credit all of our expenses because we're going to zero them out. And we're going to close them all out into our income summary. So here, very first example, I'm going to debit my sales and credit my income summary. And then the next section here is I'm going to debit my income summary and credit every single expense. Okay? And then once I get that number, I'm going to either debit or credit my income summary and close it out to my equity. Now, it's going to depend, right? Whether you have a debit balance or a credit balance. And usually, if you have a profit, you're more likely to debit your income summary. If you have a credit balance, or if you have a loss, you're more likely to have to credit your income summary, and that's going to reduce your equity. Okay, so that's all it is, right? We're going to take a look at when we solve for plugging in all of our sales and we solve for plugging in all of our expenses, our income summary should match your profit and loss. Okay, it's not going to match your equity. It's going to match your profit and loss. Okay, so once we've done that, then the last step is last, which is either debiting or crediting anything that affects your equity account. So if there's a capital contribution, you're going to zero it out. If you withdrew from your company, you're going to zero it out. And that's where your new equity is going to come into play. And once we get your new equity, that's where we're going to complete the post-closing trial balance. Which, again, if you did everything correct when it comes to closing out your revenues, your expenses, and anything that affects your equity should be equal to every single equity that we solved for so far. It should equal the equity that you solved for in your balance sheet, the equity that we solved for in your statement to the equity. That should always be equal. All right. And then, of course, when we plug in our post closing trial balance, our debits should match our credits. Okay. Any questions so far? Okay. No questions. Okay, so once again, we're going to take chapter 13 and we're going to apply it into the concept for a coffee cafe. That's our only example and sample that we have as far as exercises, because it's the perfect thing that we have to do. It's what I planned. So we went through the class project. We're going to finish up the class project by closing out the books. And like I've mentioned before, by the end of this class, you will go through every single step of the accounting cycle. Okay? So once again, the closing process is basically steps 5 through 10 of the accounting cycle. We understand that when we do a trial balance, that our debits and our credits must match. And what it is it's literally a list of every single account with an account balance. Okay? Then the steps to go ahead and close out your books is going to be, you're going to debit all of your revenues into income summary. You're going to credit all expenses to income summary. And the last step you have to do is close the income summary to your equity. Okay. Things that we're going to also look at is the financial statement. So here I kind of broke it down for you, give you like a little quick overview of how to compute each worksheet. Okay. And yep. And then last but not least, understanding what adjustments are. Okay. They can be, most adjustments are going to be non-cash transactions. Okay. Such as depreciation, amortization. Bad debt is going to be also considered a non-cash transaction. Because, right, if you think of it this way, if we have someone who owes us money on an account, and we see that they don't pay us, we have to write off that bad debt expense. But here's the real question: did we actually really receive cash? The answer is no, because this is money that people owe me. I never actually saw a day in my life for any dollar that they owed me. So for me to transfer it into my allowance for doubtful accounts and me to transfer it into and pretend and write it off as a bad debt, that's going to be considered a non-cash transaction because the money never existed. So there is no real cash that's actually going through. Okay? So just understanding that, and we're going to go through each and every single one in this class. Okay? So if there's no questions for chapter 13, then let's go ahead and dive right into our unadjusted trial balance.